What if the biggest tax shock of your life doesn't come from doing something wrong, but from finally doing something right, like retiring? Most people spend 30, 40 years doing everything correctly, paying their taxes, following the rules, never once getting a letter from HMRC that made their stomach drop. And then, within 12 months of leaving work, something changes, quietly, without warning. And suddenly they're staring at a letter they've never seen before, about money they didn't know they owed. If that sounds unsettling, good. It should, because this is real, and it's happening to people who did nothing wrong. Before we go any further, if this kind of video is useful to you, hit that like button right now. Not at the end, now, because the person sitting next to you, your sibling, your neighbor, your friend who's about to retire, they need to see this too. Share it with them. And if you're not subscribed yet, do it. This is exactly the kind of thing this channel exists for. Let's get into it. Here's something nobody explains when you leave work. The entire UK tax system, every part of it, was built on a single assumption, that you have an employer. That's it. That's the foundation everything rests on. Your employer held a tax code. That code told their payroll system exactly how much income tax to take from your salary each month before the money ever touched your hands. You never thought about it. You never had to. For decades, it ran silently in the background like a clock you never noticed because it always kept perfect time. The moment you retire, that clock stops. And HMRC doesn't write to you to explain what just changed. Your pension provider now has to request a brand new tax code from HMRC, specifically for you. But here's the problem. If they don't have one ready when your first payment goes out, and very often they don't, the law requires them to use what's called an emergency tax code. For the current tax year, that code is 1257LW 1/M1. The numbers represent your personal allowance, but the letters at the end are the part that matters. W1 means week 1, M1 means month 1. Together, they mean non-cumulative. Your pension provider treats that first payment as if it's the only income you will ever receive. There's no reference to earlier months, no carry forward of any unused allowance, just this one payment, taxed in isolation. On a regular monthly pension, the correct code usually arrives within a payment or two and things settle. But on a larger or irregular payment, you can end up with a significant amount deducted that should never have left your account in the first place. And HMRC finds out, just not straight away. Then you add the state pension into the picture and things get more complicated. The Department for Work and Pensions pays your state pension gross. No tax is ever deducted at source. It never has been. The way HMRC collects whatever tax is owed on it is by quietly reducing the tax code on your private or occupational pension, instructing that provider to take a little extra each month to cover the state pension liability at the same time. When this is set up correctly, you never notice it. It's invisible. When it isn't set up correctly, and in the first year of retirement, it frequently isn't, the tax on your state pension simply goes uncollected. Nobody flags it. No one sends a note. It just sits there, building up quietly in the background. Then, HMRC runs its end-of-year reconciliation. It spots the gap, and it sends a letter called a P800, a tax calculation through the post. Most people who receive a P800 have never seen one before, and the first thing they think is that they've done something wrong. They haven't. But the letter comes with a payment deadline. And if it covers more than a year of uncollected tax, which it sometimes does, the amount can feel like it came out of nowhere. The fix is genuinely simple, but only if you know it exists. Check the tax code on every pension payslip you receive. When you call HMRC, say exactly this. I've recently retired and I'd like to confirm that my tax code correctly reflects both my state pension and my pension income. I don't think the two have been coordinated. That specific phrasing prompts the advisor to look at both sources at once. It takes about 15 minutes. If you're in Scotland, your code will have an S prefix, S1257L, for example, because Scottish income tax rates are different. The mechanism works the same way, the rates don't. That's the first thing HMRC starts watching the moment you stop work. Now the second, and I want to ask you something directly before I get into it. Do you believe your state pension is tax-free? If your answer is yes, or even maybe you are not alone, this is one of the most widespread and costly misunderstandings in the entire world of retirement planning. And it's completely understandable because the situation genuinely looks tax-free from the outside. The state pension has always been taxable income, always. The only reason most people never noticed is that for a long time, it sat below the personal allowance, the income threshold below which no tax applies. So in practice, no tax was ever owed on it. People assumed that meant it was tax-free. It wasn't. It was just small enough that it didn't cross the line. That's changing fast. The personal allowance has been frozen at £12,570 since April 2021. It's set to stay frozen until at least April 2031. At the same time, the triple lock keeps pushing the state pension up every April. For the 2026/27 tax year, the full new state pension pays £241.30 a week. Over a full year, that's roughly £12,548. The personal allowance is £12,570. The gap between the full state pension and the tax-free threshold is currently £22 a year. Read that again, £22, which means any income on top, a small occupational pension, savings interest above your personal savings allowance, even a modest dividend from shares held outside an ISA, and you're a taxpayer, possibly for the first time in your retirement, in a situation you may never have been in before. Around 8.5 million pensioners in the UK are now income taxpayers. That number grows every single year as the triple lock carries the state pension upward while the threshold stays frozen in place. Consider someone who retires at 65, draws the full new state pension, and has a small former employer's pension paying £3,000 a year. Total income, roughly £15,548. After the personal allowance, around £2,978 is taxable. At 20%, that's just under £600 in income tax for the year, about £49 a month being quietly taken off their pension payment. Not catastrophic. But when that person notices their pension is consistently less than the amount they were quoted, and they call the pension provider to query it, they're told the deduction is correct and that HMRC instructed it. If they assumed the DWP never deducted tax from the state pension because none was owed, that assumption just cost them months of confusion and a conversation they were completely unprepared for. If HMRC can't collect the tax through a pension code because you have no private pension in payment, they may send something called a simple assessment instead. This isn't a tax return, it isn't a penalty, it isn't an investigation. HMRC does the calculation themselves and posts it to you. You check the figures. If they're right, you pay. The one thing you should never do is leave it unopened. That's when interest starts building silently in the background. Alright, pause here for a second. You're now 2 of the 5 things in, and I want to do something different with this next one. Rather than just tell you what HMRC is watching, I want you to feel the number, because this one hits differently. Since pension freedoms came in back in 2015, HMRC has paid back more than £1.6 billion to pension savers who were overtaxed on their first flexible withdrawal. £1.6 billion. The average refund in the most recent quarter was over £3,000, and that's only the people who knew they needed to claim. Nobody knows how much is still sitting unclaimed. Here's what happens. When you make your very first flexible withdrawal from a personal pension, or a SIPP, in drawdown, your provider almost certainly has no current tax code from HMRC for you. You've never taken a payment from this pot before, so the law requires them to apply that same emergency code, 1257LW1/M1. And they treat that single withdrawal as if it's going to repeat every single month for the rest of the tax year. Let's make that real with actual numbers. Someone is 63, recently retired, and takes £25,000 from their pension to clear the last of their mortgage. It's the only income they have this tax year. Their actual tax liability is fairly simple. The first £12,570 falls inside the personal allowance. The remaining £12,430 is taxed at 20%, giving a bill of about £2,486. They should receive something close to £22,500. What actually arrives in their bank account is closer to £15,500. HMRC treated the £25,000 as a monthly payment, which implied an annual income of £300,000 Dutch, and taxed it accordingly. That missing £7,000 isn't gone permanently, but getting it back requires knowing what forms to submit and actually doing it rather than waiting. There are 3 forms on gov.uk. P55Z if you've taken a partial withdrawal and the pension pot hasn't been emptied. P50Z if you've emptied the fund and have no other taxable income this year. P53Z if you've emptied the fund and do have other income. Submit the right one, and HMRC aims to process the refund within 30 days. Do not wait for the automatic year-end reconciliation. That process runs between June and November after the tax year ends, meaning a withdrawal made in April 2026 might not be corrected until autumn 2027. That's an 18-month wait for money that's already yours. There's also a simpler way to avoid the problem entirely. Take a small token withdrawal first, even £100, just to prompt HMRC into issuing a proper cumulative tax code to your provider. Wait 4 to 6 weeks, then take the larger amount at the correct rate. A short delay, far less disruptive than receiving thousands less than you expected and spending weeks trying to recover it. One thing worth knowing if you have a larger pension pot: the lifetime allowance was abolished in April 2024, but it was replaced by the lump sum allowance, currently £268,275. That's the maximum you can take as tax-free cash across all your pension schemes combined. It's not unlimited. HMRC tracks it. If you have several pension pots and the total might be approaching that figure, speak with a regulated financial advisor or a pension-wise advisor before you draw, not after. Now we're at the point in this video where I want to slow down because the last two things on this list are different in character. The first three tend to hit within the opening 12 months of retirement. Unsettling, occasionally expensive, but relatively quick to sort once you know what you're dealing with. The next two arrive more slowly. The connection to retirement isn't always obvious. And for people who've been careful long-term investors or who've kept a toe in professional life after leaving work, the numbers involved can be considerably larger. Let's talk about capital gains tax first. 3 years ago, the annual capital gains tax exempt amount, the tax-free gain you were allowed to make each year before the tax applied, was £12,300 per person. The rate on shares and funds for a basic rate taxpayer was 10%. Today, the exempt amount is £3,000. The rate is 18%. Both of those changes arrived within roughly 2 years, one tucked into an autumn statement, one in a budget. Neither came with a letter to the millions of private investors they affected. Here's what that looks like in practice. A couple who've been investing steadily for 25 years in a global equity fund held outside an ISA. They never sold a single unit during their working lives. They did everything right. They retire and begin gradually selling down to supplement their income. They sell an amount that produces a combined gain of £30,000. In the 2022/23 tax year, they would have had a combined £24,600 in tax-free gains. Only £5,400 was taxable. At the old basic rate of 10%, their bill was £540 between them. In the current tax year, their combined exempt amount is £6,000. They're taxable on £24,000. At 18%, they owe £4,320. Same couple, same fund, same gain, 8 times the tax bill in 3 years. There's a second trap hidden inside this one. Capital gains stack on top of your income. If your state pension, private pension, and any rental income already put you close to the higher rate threshold, which in 2026/27 sits at £50,270, any gain that spills above that line moves from 18% to 24%. 6 percentage points doesn't sound dramatic. On £20,000 or £30,000 of gain, the difference is several £100s in additional tax, arriving as a complete surprise to a retiree who has never once considered themselves a higher rate taxpayer. And if you're selling residential property that isn't your main home, a buy-to-let, an inherited house, a second property, there is a deadline that most people simply don't know about. You have 60 days from the date of completion to report the gain and pay the CGT to HMRC, not the end of the tax year. Not the following January, 60 days from completion. Miss it, and HMRC issues an automatic £100 penalty, with further charges accumulating beyond that. I've heard from people who were absolutely certain they had until the following January, because that's when tax has always been due. For residential property CGT, it isn't. It's a completely separate and immediate obligation, and HMRC is enforcing it. The practical response here is worth knowing. The annual ISA allowance for 2026/27 is £20,000. A strategy sometimes called a bed, an ISA, selling a holding outside the wrapper and buying the same fund back inside it, is fully HMRC approved. It moves future gains into an environment where they're permanently free of capital gains tax. If you're sitting on investments outside an ISA that you've held for years, this tax year and next are the right time to be thinking about this, not after a large gain has already landed. One note specific to this year: the rules on cash ISAs are changing in April 2027, with the cash ISA limit being reduced to £4,000 for those under 50. If sheltering cash savings is part of your planning, the current tax year may be the last full year under the existing rules. Now the fifth thing, and I want to be careful with how I say this, because for some people watching, this isn't a future concern. It may already be in motion. Retirement for most people isn't a hard stop. It's a change of pace. A day or two a week helping a former employer, some private tutoring, a buy-to-let that's been ticking along quietly for 15 years. Each of those is a completely legitimate thing to have. Each is also an income source that HMRC is actively watching in ways that many newly retired people have genuinely never had to think about before. If your net income from any kind of consulting, tutoring, or freelance work exceeds £1,000 in a tax year, you are required to register for self-assessment and file a return. You'll owe income tax on profits and Class 4 national insurance contributions, 6% on profits between £12,570 and £50,270, and 2% above that. Here's what most retired consultants don't know. Once you've reached state pension age, currently $66, you stop paying Class 4 NICs altogether. The same consultancy income, 1 year either side of that birthday, carries a very different national insurance position. That's not a loophole, it's the actual rule, but you have to know it exists to benefit from it. Rental income above the £1,000 property allowance must also be declared. HMRC now cross-references landlord data from letting agents, deposit protection schemes, and land registry records. The assumption that a modest buy-to-let sits quietly under HMRC's radar has not been reliable for several years. But here's the pattern that comes up most often, and the one that stayed with me longest. A retired professional, a teacher, a solicitor, an engineer, someone who had been doing occasional consulting work or receiving rental income since leaving their career. Not large amounts. A few hundred a month in some cases, a little more in others. They had never registered for self-assessment, not because they were hiding anything, because nobody had ever told them they needed to. And the sums felt too small to matter. HMRC can investigate underdeclared income going back 6 years for what it calls an innocent error. 6 years. Someone who retired in 2020, received consultancy income throughout, and never registered could find themselves in 2026 facing 6 years of unpaid tax, plus interest running from the date each amount was due, plus late filing penalties on top. This isn't a dramatic edge case. It's the standard outcome when HMRC's data matching catches up with something that was never declared. The amounts involved are rarely catastrophic on their own. But receiving a formal HMRC investigation notice in your late 60s, on a fixed income, in the retirement you spent 40 years building, that is a level of stress that is entirely avoidable. The way to avoid it is simple. Call HMRC and say, "I've recently retired, but I have income from consulting work or from a rental property, and I'm not certain whether I need to register for self-assessment. Can you walk me through that?" That question is not a confession. It is not an admission of anything. It is simply the sensible thing to do before HMRC finds you, rather than after. And acting first always puts you in a stronger position. Here's something worth saying before we land. You've now reached a part of this video that most viewers never get to, and that already puts you ahead of where most people are when they retire. So here's a different kind of ask. Don't just keep this to yourself. Think of one person, just one, who is within 5 years of retirement. A parent, a colleague, someone from your old workplace. Screenshot this video, send it to them. Write one line. Watch this before you retire. That one message could genuinely save them from a painful surprise. And if you want more content like this, subscribe and turn on notifications. This channel is built for exactly these conversations. Let's bring the 5 things together, because the pattern running through all of them is worth naming. Every system designed to handle your tax was built around one assumption, that you have an employer, PAYE, coding notices, end-of-year reconciliation. All of it was built for a working life. For decades, it ran on your behalf, invisible and mostly reliable, while you got on with everything else. The moment you retire, that changes. The systems that start watching you, the pension tax code mechanism, the DWP data share, the drawdown administration, the CGT reporting regime, self-assessment, none of them introduce themselves. The responsibility doesn't disappear. It quietly transfers to you. But here's what matters. Once you can see the shape of it, none of this is particularly difficult to manage. Check your tax code on every pension payslip. If the state pension and your private pension haven't been coordinated, call HMRC and ask them to sort it. Add up every source of income and compare the total to £12,570. If you're above it, confirm that HMRC is collecting the tax. Before any significant pension withdrawal, either take a small amount first to trigger a proper tax code or submit the right reclaim form immediately, P55Z, P50Z, or P53ZD, and don't wait 18 months for money that's already yours. Before selling any investment outside an ISA, check the gain, check your income for the year, and know which side of the 18% and 24% CGT boundary you fall on. And if you're selling property, remember, 60 days from completion, not the following January. And if you have any income from consulting or property, register for self-assessment now, before HMRC finds you, not after. 5 things. 1 focused afternoon to work through them properly. That's genuinely all it takes to go from exposure to in control. One important note before you go: everything in this video is general information, not personal financial advice. Your situation has its own details, your own numbers, your own timing. Anything that touches your specific circumstances belongs in a conversation with a qualified accountant, a regulated financial advisor, or PensionWise, which is free, independent, and genuinely excellent. Week after week, thoughtful and careful people walked into retirement completely unprepared for what the tax system was about to do to them, not because they were careless, because nobody told them the rules had quietly changed the moment they stopped working. That's what this was for, and if you're leaving this video knowing something you didn't know when you started, that's enough. That's exactly enough.